going to move on to Bahar Gidwani, who is the CTO and co-founder of CSRHub, which provides ESG ratings for over 20,000 public companies in 155 countries, benchmarking performance, improving ratings, and studying supply chains. Good morning, Bahar, and welcome to the 2020 Wall Street Green Summit.
Oh, thank you, Paul, and thank you, Peter. This is great to be here. I'm so excited that we can have this event. There was a time there when we were on pause, and it's nice to be done with that. I believe we are now entering a third era of ESG investment integration. Over the next 5 years, I think more than half of the world's investment managers will finally begin to integrate ESG data into their investment process. It's probably only about 15 or 20% now. 50% will be a tipping point. Beyond that, it will be downhill. The third era will be built, this third area we're entering will be built on three broad themes. You've got marketing, you've got risk avoidance, and you've got materiality. And I know my background as a data provider biases my view, but I think that the new sources of data, new ways of using them, are going to be crucial to making the transition successful. Now, we've been working in this area 13 years. We started in 2007. Back then, in the old days, in the first era, all investors were trying to do was to screen out bad behavior. They were looking for things, stocks, companies that their investors didn't want. So they tried to get rid of alcohol or animal cruelty or stem cell research. It depended on the investor's needs, and they would go through and try to screen things out. Now, one of the odd things about this was that many of the companies that they were screening out from our current view of sustainability were actually fairly good on sustainability. They were treating their employees well, they had good environmental programs, so on and so on. They just had one bad thing about them. The other thing that was odd about this is that there were often very few companies that got screened in these. For instance, I just reviewed 40,000 companies that we track, and there are only 6 that do landmines. There are only 4 that are doing embryonic stem cells. So filtering, cutting these things out didn't matter that much, didn't make that much difference, and it wasn't a holistic approach. It probably hurt investment return a bit. Most people in the investment area know any kind of screening tends to lower investment return, but it wasn't that dramatic. The second area started maybe 10 years ago. Asset owners started to believe that companies have both an obligation to earn a return, a good return on their businesses, and at the same time do no harm to society. This is one of the things Kristen mentioned. Data providers began to collect hundreds of indicators on different types of corporate behavior. Groups like the GRI, SASB, UN Global Compact started to develop systems and standards, and most investable entities started revealing at least some ESG data. At this point, we have data on about 150,000 companies around the world, both public and private, governments and so on. A lot of people have done some kind of data. Groups then, investment groups, investors, started offering funds and products that had a range of ESG-related themes like low carbon, gender sensitive, labor supporting. And this all seemed like a great thing, except that unfortunately, both the first and the second era ESG investors started producing mediocre returns. In fact, they have underperformed consistently other types of investments for the past 10 years. And if you want to know more details about this, go to my friend Henry Schilling's site. It's called sustainableinvest.com. He tracks about 1,000 ESG funds, and it's mediocre to discouraging. It hasn't worked very well. Now, this is especially troubling when you think about the fact that most investors now are starting to commit to using ESG data, to integrating ESG into their investment process. If you look at the UN PRI, which is the UN Principles for Responsible Investment, 2,800 investors have now committed to the UN PRI principles, which means they've got to start doing something along the lines of ESG. And that's what said to be 90% of world assets are now within this kind of regime. So you've got a kind of a problem here. If it's mediocre performance, but you're committed to do it, you got to somehow bring the thing together. And I think the third era will be all about bringing those two things together. And there'll be 3 ways of doing it. One way is fairly simple, which is just to kind of ignore the performance problem and talk about it from a marketing perspective. Give people what they want, give them what they think they want, And if the performance is a little bit low, it's okay, because they're getting what they want. They're getting clean air, they're getting a better future, they're getting happier people, more diversity, all the things that they desire. The second big approach would be risk avoidance. And there's always been a lot of people who are out there looking for risk avoidance strategies, and ESG makes sense as a way of avoiding risk. Just like a financial problem can sink a company, an ESG problem can sink it as well. And ESG factors might give you some advance warning about other kinds of things that might happen. So perfectly good strategy. The third one, which I think is the most exciting one, is the idea of materiality. That something that a company does internally, something that it does in its heart, will affect how it does in the world, how it does in the future. And since the company might then perform better as a company, it might perform better as a stock. So we have hope under materiality for alpha generation. And that's, I think, the thing that's always most exciting to investors, the idea that they can beat the market, beat everybody else. They're competitive. Let's go back to the marketing-based offerings. One of the problems there is data inconsistency. If you, as a marketing person in a fund, you put together something that you claim is gender diverse companies, and you based it on a data source that's told you what those are, if your asset owners look at your fund and they see that some other data source says those aren't gender diverse companies, if the data sources don't agree, you get disconnects out in the marketplace, you get dissension, you get disagreement, and you reduce your credibility of the product that you're offering. So there's been a big push by the people in the marketing side to improve data consistency, to get the various different data sources to somehow agree about everything. And the risk avoidance side, one of the issues is that the risk avoidance sources don't correlate with the ESG sources. So a risk avoidance source has to be twitchy, has to be short-term, has to be right away, get them out of that stock. That's totally different from the way that most of the ESG data sources look at things. We've correlated our data against one of the major ESG data sources, and we found a 2% correlation. Against one of the major risk data sources, 2% correlation. So 2% correlation says people are going to have trouble fitting these things together. If you're going after materiality analysis, one of the problems is that there's a lot of holes in the data. If you look at any of the major data sources, they are mostly empty. The largest data source based on self-reported data from companies has over 10,000 companies in it, has over 1,000 indicators, and it's over 70% empty. The largest expert source has about 690, 700 data elements in it. It covers about 6,000 companies. It's 70% empty. So if you're an investor and you have a 1 in 3 chance of getting the data you need when you go to a source, that's a problem, because you cannot do a materiality analysis unless the data is filled in. I mentioned that everyone was trying to get everyone to agree and kind of bring it all together into one place. This is where GRI, SASB, SDGs, TCFD, I mean, we've already had WFE, more kinds of acronyms than you can possibly imagine. It's a great thing. If the IFRS is getting involved, that's wonderful. Everybody's involved. They're all sitting and talking. You know how long it takes people to talk about standards. It takes months and years. It's going to be years before the standards guys agree about what standard they're going to want to use. And it's going to take more years for companies to build systems, to produce data according to those standards. And it's going to take more years for smaller and less involved companies to get on board. We are not going to see standardized data of any type for any use in this market, at least for 10 years and maybe for 20 years. So if I'm right, and in the next 5 years, everyone's going to adopt this stuff, they're going to have to be adopting it on a base of data that's a little bit flaky, it's got some problems. They're going to have to figure out ways around it. And towards that, I think there's some new data sources that are coming along that are very interesting, based on various kinds of technologies. Ours is based on big data. There are also natural language processing, artificial intelligence approaches. There are people who are doing very nice specialized data sets on certain aspects of sustainability. I think that gives us some hope. These data sets, our data sets, for instance, is 91% complete across the 20,000 companies we track and has an 11.5-year data history. That's kind of new, and quantitative analysts like that. So let's assume that these data sets come together, people use them, they can combine everything together. One of the cool things you can start to see is correlation between ESG data and company behavior. Not talking stock market yet, but company behavior. We've correlated with brand strength, reputational risk, digital communication quality, cost of credit. These are good correlations that show you there's a connection, and you can start to say, if a company does this on ESG, it might do that financially or long-term have a benefit that could turn into a stock market benefit. You also, I think, will start to see anomalies and start to better understand them. We just published a paper in the Journal of Investing about reversion to the mean. The top-rated ESG companies systematically move downward. The bottom-rated ones systematically move upward. It's held true over 10 years. We have it across 30,000 observations, so the T-scores are great. Once you get large sets of data and you understand anomalies, you learn which investment strategies may or may not work. For instance, a buy the best strategy, sell the worst strategy gets all messed up when the two different types of companies converge together. The best become the next to best, and the worst become the next to worst. You then have to churn your portfolio, and if your thesis was best is going to give me the best return, you're out of luck. It may make more sense to buy the next to best or the next to worst, or sell the next to worst, and then work changes in direction. So I'm optimistic about the future. I think we're going to have a great future here over these next 5 years. As more and more investors get involved, we're going to learn a lot. We're going to use some of the data that's out there. We're going to develop new kinds of data. We're going to harmonize gradually to some extent, but even more than that, we're going to see people taking advantage of the disharmony, taking advantage of the differences between the different data sets, and finding ways to make money out of it. And we may see the emergence of our first set of really famous and exciting ESG investment managers attracting a whole bunch of new money into the market as a result.
Great, Bahar. So we've got several questions for you. The first one comes from Phil Kirschman at Impact Metropolis. Do you have any comments about the effort by CFA Institute, excuse me, to create ESG disclosure standards for investment products?
Okay, so I will let you know I am a CFA, and I have looked at what they're trying to do, and like everything else everyone else is trying to do, great. But if I say that the world is green and you say the world is blue, it's going to take us a while before we agree what the color really is. And introducing yet another new approach, another new standard, even if it somehow might appear to be better to the people involved, is not nearly as good, I think, as getting on board with the existing ones. We've seen something called the Corporate Reporting Dialogue bring together several of the major groups into one room, and they've recently announced that they're going to start cross-adopting standards and sharing standards. This is GRI, CDP, SASB, IFRS. It's really good news for all of us, but it's just getting started right now, and a new standard doesn't help at this point.
Okay, and here's another question for you. Are there any software programs that cover scope 1, 2, and 3 for reporting purposes?
Well, scope 1, 2, and 3, the problem with all three of those numbers is that they're extremely fungible. What do you include? How do you calculate it? And there are tons of different great programs for trying to do it, but they don't agree at the fundamental level about how to capture the information. They don't agree at the fundamental level how to interpret the information. They're based on various kinds of models, various kinds of estimates. So if you take one company, compare it to another company, and you try to compare their scope 1, 2, and 3, you're not comparing apples to apples, you're comparing apples to kumquats at this point. I think it's going to be that way again for the next 5 years. It makes more sense to, I think, to compare how people feel or believe a company's scope 1, 2, and 3 looks compared to how another group, the same group, feels that another company is performing. Consensus you can compare. We know whether one company is thought to be better than another company, but whether they actually are or not, what the truth is, we cannot yet perceive, unfortunately.
Okay, and Bahar, you've got 30 seconds to answer the following question, which just came in, and that in looking at multiple data sources, how do you weigh information differently to recognize whether the data comes from a small, obscure source that only looks at a few companies versus data that comes from large data sets that may be more credible?
Well, I'm happy to share details of the big data approach that we took. It's a proprietary algorithm. There are probably a lot of different ways of doing this. Just email me at bahar@csrhub.com and I'll engage in that conversation. We love to talk to people about this. It's not easy, but it can be done.
Great. Well, Bahar, thank you very much for your comments this morning.